Yeah, so welcome again, everybody. Thank you so much for being here. I really think you're going to get a kick out of this. And with that, let's kick things off. How is today going to go? How's the next hour going to go? Well, I want to do, I don't know, I got maybe about 50 slides I want to show you guys. Some are going to be pretty quick. But if possible, if time allows, I also really want to do a little bit of an interactive sort of training or some interactive market stats using some of our market reports. I guess those are PDF and not interactive, but also InfoSparks, which is, of course, interactive. So with a little bit of luck, we'll be able to get there as well. Okay. So here we are, folks. It is June 2023 still, believe it or not. And we are living in a changing market, right? It is definitely a changing market. Maybe it hasn't changed as much as we thought, or maybe it has changed as much as we thought, or maybe some of the worst of the changes could be behind us. We'll look at that. But I really do want us to kind of have our thinking hats on and be open to new data. And maybe that'll change your opinion a little bit. Maybe it'll confirm some of your theories and theses. But be thinking about that. So where do I find all these many wonderful reports that Mark produces to help me succeed? Well, the place I would go is FastStats, and you guys can access it right from our homepage, mplsrealtor.com. If you just scroll down to this Today in the Market section, you'll see all of our reports. The other option is to go to market data. You guys can also kind of see that up here. Oh, you know what? You may not be able to see my mouse. So you can either go to mplsrealtor.com and just scroll down to Today in the Market, or you can click on market data and you'll see similar reports, a couple extras, and you'll just see them in kind of a different format. So it's whatever works for you. I'm still a little bit of a fledgling housing nerd. So what does all this mean again? Well, lucky for us, we've got a whole bunch of definitions and metrics and ways to help us think through, what the metrics, what they represent, what they mean, their implications, different ramifications for buyers and sellers, stuff like that. So pendings, percent of original list, cumulative days on market, absorption rates or month supply. We've got these all defined. So don't be embarrassed if you're not 100% certain. Be embarrassed if you're not willing to try, right? Don't feel bad if you don't have it all. You can get it all, I promise you. But those who feel just overwhelmed or not interested in trying, I think that's where the frustration comes. So just be open to this stuff and know once you get enough miles or enough flight hours behind the controls, you're going to just learn it like the back of your hand. So patience is a virtue here. I'm sorry, you said you have how many reports now? We got a lot. We have a lot. We've got a weekly report, just like what you thought. That's a weekly frequency. Then we've got the market pulse. I really like the pulse. If we have time, we'll look at that one too. That is our only report that highlights showing activity. I don't like to say it shows showings. Monthly indicators, I won't go through all these guys. Our locals, the housing supply overview, foreclosure report, just what you think it is. Annual report comes out roughly every 12 months. Most people age 12 months each year. I get 18 months older every year. Our skinny video, sort of a handy, web ready, social media ready little piece that you guys can post, for your sphere, your circle. Quick takes, a little bit more as needed. When we see something sort of dramatic changing, we'll do some of these short videos explaining some of the dynamics. Webinars, you are here. You are in this thing right now, in this webinar with us. So thanks for being here. Sortable stats, pretty cool tool that's, I think, overlooked. Hoping we have time to dive into that one. And then InfoSparks. I don't hide it, you guys. It's the holy grail. There's not really another way to say it. Any metric, any time frame going back to 2005, any breakout, any property type, any construction type, any size, comparisons with other areas, sharing on social media, exporting the wrong data, the raw data. Sorry, it's not the wrong data, the raw data. So there's just so many ways to benefit from the tool. So why do we care about all this? Well, you guys are real estate professionals and you help people achieve their real estate goals, right? As you help people achieve their real estate goals, whether acquiring, unloading property, investing, what have you, they're going to ask you questions. They want to know things. They want you to tell them things, right? They want to know what's going on, what are the details. And so here are just some examples of some popular questions. Is it a buyer's or a seller's market? Month supply of inventory. If we're at 9 months of supply, it's a buyer's market. Lately, we've had 1.8 or 2 months of supply, still technically a seller's market, believe it or not. How do the property types compare? Townhomes and condos versus single family. We can do that really easily. Prices, are they up, flat, or down? We've got median sales price, average sales price, and price per square foot. So it's really not just this one. How long will it take me to sell my home? Well, we've got days on market. How much of my asking price will I receive? We've got percent of original list price. When do I have the most options as a buyer? We've got inventory, so on and so forth. So I sort of say, be the expert that you wish to see in the market. All right, some of you have seen this one. I kind of get a kick out of it. It's sort of a little discouraging, a little bit depressing, but it does kind of keep things in context a little bit. And I think that's important now. So the year is 1982. Conventional rates starting at 18% with a point, but you can buy down to 16 3/4 with 5.5 points. And you guys are hearing people complaining about, 6.7%, 6.8%. Well, it's definitely different than the 3.5 or 4% we've seen for a while, even sub 3% we've seen for a while. But it's still, half of this high, not even, it's still well below half of this high. And it's actually still below its 50-year average on the 30-year, which is about 8%, 7.9 or 8%. So still better, although definitely not as excellent as it has been. Anybody know Jim Duffy? Feel free to page him. There's his pager number, 538-1709. The Great Mean Reversion, you guys. I know some of you have seen this one. I like to pull this one up. Every year it's updated. And actually right about now, about halfway through the year, we'll sometimes do a year-to-date pull where we'll show kind of how things look year-to-date. And I think you got to wait till the middle of the year to do that because you've got some of the slower winter months in the first quarter, but then you've got your Aprils, Mays, your April, May, and June, which tend to be, stronger months, obviously. So the last time inflation was this high, although it's sure come down a lot, but the last time inflation was as high as it was last year was in the early 80s, right? That's when we're comparing against to. By the way, no coincidence that it's the early 80s when rates were so high because inflation was so high. So now we're in this inflationary environment again, or actually seems like getting out of the inflationary environment. And so no surprise that rates have to rise again, just as they did back then. So as they increased rates, it's not that home prices crashed, but they did kind of level out a bit until they hit the trend line again. And then we really inflated our bubble, and then we had the crash. And you guys can actually see we've had recovery for many years, but the last year or two in particular really do show this kind of more dramatic slope, right? A more extreme increase, a little bit more of a steeper slope there. I would anticipate moving forward, probably a little bit more like that. Maybe we have a year of that before that. Pretty hard to see us having something like this. It just doesn't make sense. It's pretty hard to see that, but not impossible to see, a year or two of a slight decline. We'll get into it way more, but we have had a monthly decline or two, but it's possible that we have 2 or 3 or 4 monthly declines without ever having a yearly decline, if that makes sense. So sometimes we obviously look at month over month over month over month, but then we do year over year over year. And each year, of course, has 12 months. So if only 3 of those 12 months were down, sometimes the other 9 months will sort of uplift the year as a whole. So anyway, kind of some geeky stuff, but something to think about. My animations are not working quite as I had hoped. That's okay. Animations are always a mistake. I'll always avoid the animations. So take a look at this, you guys. This one goes back to the late 60s, and this really does show this balance or the relationship between supply and demand. You've got, or I should say between buyers and sellers, so similar. You've got new listings or seller activity in blue, and then you've got sales or buyer demand in red. 3 big things to note. The first 2 are pretty easy. I like to say Mount Everest and K2. Right, so look at this increase in supply, but we didn't really have a corresponding increase in demand. Right, and then we had that early 91 recession. And then look at this. Look at our run up in supply. Look at what sellers were doing, new listings. Some of these are downtown condos. Some of these are, Lennar doing new builds in the suburbs and new subdivisions. So it really depends. But look at this run up in supply. Demand, well, it was sort of there at the beginning, but then it wasn't, right? Lehman collapsed. People got laid off. The economy really went through a tumultuous period. Here's the third thing that I want us to notice. We've downshifted together, right? We've downshifted together. So this is worrisome. When we see here, when we see something like this going on, right? We call that divergence. This way more extreme. We call that divergence. If things looked like this, we'd call that convergence. Right. And we sort of had that here. Well, yeah, we definitely had that here. So that's really when the market tightened up, when we had this convergence between supply and demand. Look at how tight the market got, right? Look at this relationship between supply and demand. We didn't have this much room, but things were pretty tight here, and they've been pretty tight here as well. Now, what's the key? Let me erase all my chicken scratch. What's the key? The key is this, is that both have moved down together, right? So here's what listings have done. Here's what sales have done. It's not really divergence or convergence. It's just that supply and demand are moving in tandem. They're not diverging or converging. They've shifted, but the relationship is still close. Does that make sense? I know that's a little wonky, but they've downshifted into a lower gear together. The worry was, of course, oh, I'm a seller. I'm going to look to take advantage of peak pricing during the peak of this cycle, and I'm going to dump all my homes online. Buyers, well, they've got they can't get qualified for loans. They don't want to pay 7% interest. So this would have been pretty extreme divergence, and that would have gotten us into trouble. That's when you see prices softening, market times exploding, sellers getting 90, 95% of list price instead of 100, 101, like what we see now. So again, I want us to be thinking about that as well. New listings for May. So we're sort of getting into our usual suspects, as I sometimes call them. Had a lot of May listings back in 06, 07. Rode the wave down kind of into the crash and the Great Recession. Actually looked like some pretty stable performance, pretty slow but reliable growth, right? Slow but fairly consistent growth. And then enter COVID and everything changed, right? So new listings down, at first, and then up a little bit as folks were moving, but a lot of that demand came from first-time home buyers. So they didn't have a home to list, when they bought one. Some folks bought a second home. So a couple different dynamics happening there. Overall, new listings last month were down about 17.33%. And you guys can see that 66.75 number is in between our two lowest Mays, which happened in 2010 and 2012. So not a great stat here. There was a time when seller activity was down much more. So there's some evidence perhaps the worst of the declines could be behind us. No guarantees. So April closed sales, okay, so down 31% to 33.27. That is the slowest April I have on record since 03. Let me say that again. April closed sales this year, 33.27. Lower than the 33.49, although not by much. But April of this year was the lowest closed sale count for any April going all the way back to 03. That's a 2-decade low. That's not nothing. That's something to kind of pay attention to. Okay, so those were April pendings. How about May pendings? A little bit of a different story. So, what was April? Down 31%, May down more like 19%, and a 49.02, which really is pretty close to, some of these other levels that are a little bit more in the mix and not sort of these extreme sort of bottom of the barrel lows. Okay, let's keep trucking here. Well, I suppose it's also worth noting here, this one's interesting, May of 21, 68.90. I suppose May of 2016 even higher, but this 68.90, right, easily surpassed this sort of, all-time high during the bubble. So existing home sales, kind of interesting. This is from NAR and, sort of analysis and data visualization done by my friend Bill McBride at the Calculated Risk blog. He does a terrific job. Very much encourage you guys to check it out. He does some econ, some housing, a little bit of demographic and socioeconomic stuff, but it really does have a housing focus. And he does a really good job. So existing home sales at a seasonally adjusted annualized rate. Really see sales peak in 05-06, come way down, then back up. And look at the COVID bump, right? Here's that blip COVID recession. Market came way down. And then everybody needed to buy a home, wanted to buy a home. Market came up. And then the Fed poured cold water on us with higher interest rates. And then things kind of came back down. And this is kind of interesting, you guys. I don't mean to split hairs, but sometimes, in stocks, you might call this a double bottom or a retest of the lows. It was sort of retesting those lows, and it's not like a stock market, it's not like trading, but you guys can kind of see it. It just kind of went back down to those lows, and maybe now it's bouncing, right? Maybe now it's going to bounce a little bit higher. So pay attention to this one. Almost identical story. That was sales. This is the housing market index, HMI. Similar story, guys, right? Kind of down during COVID, way up during the housing frenzy, and then down again with higher rates. And now some early evidence that things are getting a little bit better. Some early evidence. CDOM, cumulative days on market. Remember, this is list to pend, not list to close, but list to under contract. Also remember, if you had 2 different listing periods within the year, we really do count cumulative days. So if you were on the market for 10 days and then you were off for a few days and then you're back on for another 10 days, you were really on for 20 days, right? You're not going to trick us. Stop trying to fool me. No. And so that gives a better picture of the truth, right? It gives a more complete picture of how long sellers have to wait, or how long it's taking sellers to get good offers that they're happy with, or to get adequate offers that they're satisfied with. 125, 115 days, even 2 months, right? 60 days sure seems like a while. 35 days down to about 1 month, right? Month and half a week. Look at what's happened lately. So a couple really important notes here. And you know what? Let me zoom in again. Couple pretty important points here. First point is 86% increase looks pretty extreme, right? An 86% increase appears fairly extreme. That's the first observation. Second observation, but is it extreme, right? Is it extreme? So if we went from 7 to 14, that would be doubling. So that would be 100%. We almost did that. We almost doubled. Here's the key. The key is this 13 is still lower than pre-COVID. In fact, May of 2020, right, was a COVID month. There's a lot going on in the metro and in the city that month of that year. Fateful month, but 13 is still lower than 16, 17, and 16. So it's tempting to look at this. It's tempting to look at that and say, well, this is the anomaly, right? 13 is the anomaly because we were selling in a week in 7. Well, not really. 7 is the anomaly, right? These are the outliers. 16 and 13 are a little bit more normal. In fact, those are historically really quick. But 7 is sort of absurdly fast, right? A week. And this is a median, meaning what? Half the homes taking longer than a week and half the homes taking under 7 days to get an offer. That's pretty crazy. So just careful what you believe. And I feel bad for people who just get their news from the media. Well, let me walk that back. I feel bad for people. I feel bad when people hear stories in the media. Again, I'm not talking left-leaning media, right-leaning media. I don't care if you're CNN or Fox News, doesn't matter. Both of them and all outlets across the media spectrum have a tendency to sensationalize, right? So what do I mean by that? I guess I feel bad if people just believe the sensationalism that, oh my God, it's taking sellers twice as long to sell their home and the market's crashing, right? That's not really helpful. It's also not really accurate. And it also puts the blinders on, right? Where you're not seeing the whole picture. So if you open up the blinders just a little bit, you'll be able to see something like this. This is the exception or the anomaly, right? This is more the norm. These are a little bit more the norm. In fact, this is a little bit more the norm historically, but you guys can see we're clearly well below that. So just a couple grains of salt, a couple kernels of salt on that one. Maybe a whole shaker of salt, to be honest. All right, median sales price, April. Time check, we're at 225. Okay, I think we're doing all right on time. Median sales price. Down just a hair for April. This is April. Down just a hair. 370 to 369.9. Didn't even register in the 10th place of our percent change. So pretty flat. May. May is where we do register a 1.3% decrease in the median sales price in our region. Let's draw a line. Let's draw a line. Okay. So we've got this line. This line's a pretty good line. Check this out, you guys. The line passes right through the midpoint of our bar for the most part, passes right through the middle of most of these bars. What do you notice about the last 3 Mays? Well, I noticed they're all above the bar, aren't they? Right? Every single one of them. Every single one is above the bar. That tells us that price growth has been above average, and boy, has it ever, plus 17%, plus 9%. So here's the kicker when we see minus 1.3. We are still well above our trend line. And I mean, right, so we had these 2 big gains followed by a very small decline. And notice we are still well above this blue linear trend, right? Let me say that again. We are still well above that blue linear trend. Okay, let me just check something, guys. Okay, so what that means, well, what that means is that we've coughed up a very little bit, but that the sky's not falling, not at all. So I think some people believe that we're here, right? I think some people believe that we're there, and we're not. We're not there, and facts matter, and we are just not there. I mean, we're not even here, right? So some people really want to believe that we're kind of here all over again. They want to believe that we're here. I understand that you want to pay 300 grand, but the house is 400 grand, right? I understand, but it's just not where things are. And I think we're unlikely to be, I'd be surprised if we got much below that line. It's possible we meet back up with it. It's possible that we dip below it and kind of get back up, but just know, you guys, we were well above and still above, but the gap is smaller, right? We used to have a big gap, and now it's obviously a little bit less. So a couple things to think about there. So this one's pretty interesting. This is from KCM, Keeping Current Matters. It's always important to cite our sources. And they're showing the Case-Shiller data, Federal Housing Finance Agency, and the CoreLogic data. And look at how interesting. So if headlines saying home prices would drop 20% had you worried, well, check this out. Nationally, there's some evidence that prices have already hit their low point, and now they're actually starting to rise again nationally, not necessarily locally. But what do we know about national? It blends together lower Manhattan and rural Louisiana, right? And those are two very, very different places. But look at how interesting it is. And the trend, that we say the trend is your friend. Well, that's a bad start. Let's go a little bit more like that. And you guys can see, right, there's already a green. Kind of see like that, maybe a little bit of that. And now we've already had two greens. This guy a little bit more like that, and then maybe a little bit like that. And here again, two greens. So pretty interesting stuff, guys. I think that's pretty interesting and definitely worth watching. Not all metros, not all cities, not all neighborhoods are the same. So careful with how broad of a brush stroke you paint using that information. Okay, so here we are, April. This is the ratio of sold price to list price. So if you accepted a little bit less of your asking price, maybe 98, 99%, versus if you had multiple offers and you took 102, 2 or 3% over, then that would be, like this, 103, 104%. But that's not where we're at, or at least that's not where we were at in April. April came in at 99.9%. You can't make up that number. Also really interesting that it matched the 2020 and the 2018 level. The previous two Aprils, yes, were outliers, right? Anomalies, 103.3 and 103.8. Those sellers got 100% of their list price plus almost 4% because multiple offers, right? So yes, we've come down, but we still stood at 99.9%. That's a pretty strong figure. How about May? Last month, guys, we stood at 101.1%. It is notably below the 104 and 104.1, but it is also notably above some of these pre-COVID levels and notably above bubble levels as well, right? Sort of peak of the bubble here. So I find that pretty interesting. Inventory, May inventory, what's going on here? Can you guys believe we once had 36,000 properties for sale listed under active status in North Star? What did we end up with last month? About 6,900, right? Not even 7,000. So I had a little bit of growth last year, probably because that's when rates really started to rise and we saw a little bit of a slowdown then. But even despite that, right, it never got us close to where we were sort of pre-COVID. So, people kind of hunkering down, a lot of buyers out there, fewer sellers. And so inventory really kind of evaporated. And it is still thin, very, very thin. Interesting little factoid here. Turns out, folks, we actually need 20,000 active listings to be a balanced market. That would be here. That would put us right about here, right? So, right, last time we had almost 20,000 was 11 years ago. Yay, right? So about 4,000 sales a month. So 20,000 actives divided by an average of 4,000 sales per month gets us to our 5 months supply of inventory. Hoping everybody is still with me on that. Speaking of months supply of inventory, let's talk about it for just 20 to 30 seconds. So someone should hold me to that. All right. Pre-crash, 4 or 5 months of supply, pretty average. Into the crash went 7 to 9 to 11 months of supply. This is a buyer's market, right? Let's do our drawing. This is a buyer's market. Let's draw, well, 5.5. Yeah, let's do 5.5, something like this. Let's see how steady my hand can be. Hey, not bad, actually, not bad. So these, you guys, are buyer's markets. Under 5 or 6 months of supply are sellers markets, where sellers have the power, sellers are in control. Here, buyers are going around and they can maybe offer, 10% less than what you're asking. And if you're desperate enough, you'll take it, right? So 7, 11, right? 8 months of supply. These are buyers markets. Here, right? 5 months, we were kind of a balanced market. Well, maybe I'll put BA for balanced market. And then you guys can kind of see what happened. Especially noticeable what happened with COVID here, where we just had a run on housing and it really showed up in the data. So specifically, 1.8 months, still a tight market, not as tight as 1.1 or 1.4. And I think people are feeling that, right? That it's still a tight market. There's still some multiple offers. We actually hear that there's multiples on everything from 200,000 up to 1.8 million. Still pretty impressive, guys. Some of the luxury stuff is cash sales. Actually, I'm always shocked at just how much of the luxury market is cash sales. So those folks aren't as rate sensitive as, say, a first-time home buyer household just starting out, say, at a little bit of a more modest income. So 1.8 months of supply, definitely still a tight market, but we did plus 28% and now plus another 23.5%. So things definitely changing. But let me say again, you guys, I think there are some buyers, some people who believe we are at 6 months or 8 months of supply, and we're just not, right? That's the fact. We're just not. They can think that. You can be entitled to your own opinion, but not to your own facts. That's where you're not entitled to your own facts. All right, guys, so what's happening? Year-over-year change in price. Remember the crash? Do you guys remember the tax credit? And then the market had to kind of find its footing organically after that government incentive disappeared. We could argue whether that was a good spend of our tax dollars. Put a couple bucks in your pockets, hopefully, but it didn't really lead to widespread market turnaround. So I think it's okay to have a policy debate on that, on whether that sort of incentive, worked and whether we should keep it in the toolbox moving forward. Early phase of recovery. Look at this, guys. Prices rallying 15, 16%. A lot of flippers and investors here. And then we kind of normalized a little bit, like what, 5 to 7, 4 to 6%, which is pretty typical. And then COVID, and suddenly prices were rising at 15, 10, 15% again. And then higher interest rates. And you guys can see now we're showing that minus 1.33% price decline. It's sort of anyone's guess what this looks like. I find it absolutely impossible to think we would get anywhere near here. I'd actually be shocked if we got to, probably even 5, 6, or 7, frankly. But we could have a couple, like this, or maybe we do 1.3 and June is minus 2.1, and then we're back to 0 or above 0. It really depends. Let's see what happens with rates. I know there's tons of buyers waiting in the wings. You guys hear that? I know that. What do you call that? Pent-up demand. There's a lot of pent-up demand out there, and pent-up supply, right? People who are holding on to their 3% mortgage rates, and you can't pry it from their cold, dead fingers. So those guys are hanging on. And by the way, even if they had to buy their current home again at today's prices and today's interest rates, even then they might have some affordability challenges, right? So kind of a lot of moving pieces there. Why? Oh, that's why. Give you guys a second to take that in. Yeah, the housing market explained. So in 2021, maybe this house was 600K at 3% interest, $2,000 a month, right? Relatively affordable for a 2-earner household, each making around the median, right? Relatively. Well, maybe for California. I know 600 is not exactly in the affordable ranges, here, but 600 is cheap in California and New York. So 2022, yeah, maybe you'll get the house for a little bit less. Instead of 600, maybe 585 or 590, maybe 579.9 if you're really lucky. But at 7% interest, your payment on the same home is 3,100. That's another 12 grand a year just on interest, right? Just on interest. That's the challenge, right? This is the challenge that we're in. And it, again, this also proves or affirms a really good point. And we've been saying it for a while. I know so have you guys. This is a monthly payment business, right? Payments matter more than home prices. So here the price was higher. So people might look at that and say, oh, the price is higher, I can't buy it. Sure, the price was higher, but the rate was better. So your payment is lower. And that's really the cost, right? That's really the cost. Year over year change in sales. Thirsty today, guys, forgive me. Maybe all the smoke in our atmosphere, a little bit better today, but yesterday was really something. Only silver lining is really pretty sunsets. That's the only silver lining there. Okay, so we looked at year over year change in prices. Now let's take a look at year over year change in sales. Sort of a couple different phases or cycles. I'll just call these out briefly. There's our tax credit period, remember 09 into kind of early 2010. So it did incentivize some demand as we knew, but some of that demand was focused on highly affordable product, right? And also prices were down because home prices were down. And so people were buying more affordable stuff. So sales can surge even if prices are flat or down. So that speaks to, it's not just supply and demand that determine prices, right? Supply, demand, or supply and demand, but it's also what we call the product mix, or the mix of homes that happen to sell. If you've got more million plus out on the big lake or Edina or North Oaks or wherever, those million plus deals are going to skew prices. If you've got a lot of foreclosures or condos or land or what have you, for 150, 180, 225, that's going to skew things a little bit lower. So I do also want us to be thinking about that skew a little bit. So look at year over year change in sales. The declines were about as dramatic as we've seen in the last 20 years. They were just about as dramatic as we've seen, but this is encouraging. My question is, again, are the worst of the declines behind us? There's some evidence that maybe they are, right? There's some evidence that maybe they are. If you look at the last two red bars here, you'll notice they're a lot smaller than the 1, 2, 3, 4, 5 bars that precede them. So again, I don't mean to read too much into the tea leaves or split hairs, but to me, this is an early sign that maybe the worst of the declines are behind us. No guarantees, not even necessarily a forecast, but I am saying it looks like that could be the case. Another interesting one here. This is from Jay Breck, JBREC, John Burns Real Estate Consulting. Average cancellation rate. Rates really started to surge on us March, April, into May, June last year. Look at the cancellation rate. Instead of taking a lower price, pull your listing. Just pull it from the market, right? Just pull it from the market. Try again next year. Try again in the spring. So we saw that cancellation rate really surge. And now back down to 10s. I guess we're used to 10s, 8s, 9s, 7s, 10, 10s, 11s. So back to what? 2019 levels. All right, closed sales by property type. Getting back to our metro here. Time check 2:43. I think we're doing okay. We might have to speed up just a little bit. Single family down about 32, condos down about 35, townhomes, interesting, down only about 14. So not the biggest gainer, but it's the smallest loser, right? It's the smallest loser. So that's a good thing. how are buyers adapting? So, okay, so maybe townhomes are a little bit more interesting to some buyers, younger buyers looking to keep their payments under 2,000 a month, but also downsizing baby boomers who are frankly done with lawn and snow care, lawn care and snow removal. We got aging backs, you guys. What are we going to do? Knees too. So how else are buyers adapting? Well, are they buying smaller homes? Kind of. Look at the median square footage, 1850, 60, 80, 1900 square, and then back down to 1890, and then a little bit of a gain last year. So everybody needed more space in 2020 for working remotely and learning remotely and entertaining at home. And so we saw that impact on square footage. Then with higher interest rates, we started to see that pattern reverse a little bit, even though we saw a little bit of growth. You're talking 3 square feet, guys, from 1891 to 1894. Not exactly something to write home about, but I wanted to show that. And similarly, and on a related note, right, bigger homes tend to have more bedrooms. So let's look at the share of homes with 4+ beds. Pretty interesting. See growth. Look at 2020 heading into our COVID year, or I should say our worst COVID year. 41.5% of sales had 4+ beds, dropping to 40.7, and then dropping even a little further to 40.6. I think I'm pretty confident that this partly reflects the need of buyers to adapt and rethink their product that they're looking for to get their payments at a point that they're comfortable with, in a place that they're happy with. Housing units under construction, 2+ units in blue, 1 unit properties under construction in red, all the way back to 1970. Can definitely see a little bit of the business cycle or the rate cycle, but this is what's pretty interesting. Well, a couple really interesting, really just 2 interesting things in the interest of time. One, look at red, you guys. We used to be producing way more 1 unit structures than 2. Red was ahead of blue for the longest time. And then something changed after the crash, and now 2 unit structures have pretty much been above 1 unit. That's the first observation. The second observation is divergence, right? Divergence. So 2+ units still rocking and rolling, pretty much back to almost back to 50-year highs since 1972. Some of you remember that year, a little bit before my time, but maybe they were starting to think about it. So look at this, you guys. We've seen single family unit development or 1 unit structures really pull back as multifamily is still cranking. Builders are looking to sell the units that they've got. They're looking to make deals and sweeten the pot a little bit. They already brought all the dirt forward in their pipeline. They already built and got all the labor they could and all the materials they could and dealing with shortages. But now the homes are sitting. And so, right, they're not developing as much, which I think is unfortunate, because when rates do normalize a little bit, I think you're going to have people coming out of the woodwork, and we're still not going to have homes to sell them. That's my fear. Speaking of not having homes to sell people, are millennials fueling a generational bubble? Not that we're in a housing bubble right now, but are they starting to fuel a generational bubble? What do they mean? So all this demand for millennials, who are a huge generation, by the way, and they're at their peak age for home buying and household formations. But baby boomers are downsizing, and they will be a drag on demand. And so we're building all these homes for millennials. But as baby boomers downsize and sell their homes, and as the next generation behind the millennials just aren't as big, could we actually have an oversupply of homes on the market? What are they saying? By 2030, I think I've got this called out. Demand reversal will intensify by the mid 2030s. So look, we've got 12, 13, you know, we've got over a decade to think about this. But I think it's a pretty interesting theory, and I'm not sure it's scary. It shouldn't be scary. It's not meant to scare anyone, but I do think, as real estate professionals and housing practitioners, I think we should be thinking about this long term. And you guys are doing business planning, and sometimes that's long-term business planning. So I thought this was an interesting article, a really interesting article. Anyway, take a peek. All right, luxury, pivoting a little bit, closed sales over 1 million. I know most of you have seen this. We got a couple extra folks on the call here. I know some of you have seen this. Just know that million plus has almost doubled from 760 to almost 1,500 in 2 years. Still did another 7.5%. What about May? Let's do year to date through May. So 95 in 2021, up to 101 in 2022, and now back all the way back down to 94 here in May of 2023, at least year to date. So, I guess we're coming down from the highs, but we're not back down here, folks, right? This is still elevated, well above sort of historical averages. So luxury is still rocking and rolling. Pending sales. Wait a sec. Yeah, pending sales. So some people, some people like cities and some people don't like cities. Some people, well, we'll leave it at that. So some might have thought that sales in the cities would plummet. Minneapolis is actually down less than the metro as a whole. St. Paul is down more than the metro as a whole. And maybe that's because they did the rent control policy. So maybe a little bit less likely to buy there, especially if I'm an investor or a land or a housing provider. So maybe that could be reflected a little bit. Let's keep going though. Median days on market. Minneapolis in blue, St. Paul in red, Twin Cities in green. So days on market. All right, actually, St. Paul homes selling the quickest. Minneapolis and the metro as a whole, both at 13. Minneapolis actually slow back then, but St. Paul just about as fast as the Twin Cities, and now actually even faster. So pretty interesting there. So maybe that sort of complicates our thinking there. How about median sales price? If I can't raise rent on my unit, I may not be as likely to spend as much on it or offer as much. Let's see if that theory is right. Minneapolis prices down 3.1, St. Paul prices up 1.2, metro prices down 1.3. So this one is a little bit interesting too. It may kind of complicate or problematize. I think I had a professor who used to like that word. It kind of problematizes things a little bit. It creates a problem. So it complicates our theory. If that's your theory, it might complicate that a little bit. Yes, guys, there's other dynamics, tons of other dynamics going on, and multiple things can be true at the same time. We can walk and chew gum at the same time. Percent of original list price. Let's take a peek at this one. So most recently for last month, Minneapolis at 100%, St. Paul at 102%, and then the metro at 100% again. So actually, I guess people are willing to spend not only full list price, but then go 2% over. I think that one has to do with the fact that prices in St. Paul are still lower. And so even going 2% over will still be a better payment than if you lived in not the real city, the other big city, the other beautiful core city, or, somewhere in the suburbs or the metro as a whole. So kind of interesting data there. How about price per square foot? Let's correct for the fact that maybe there's bigger homes or smaller homes selling. Okay. $240 a foot in Minneapolis, $212 a foot in St. Paul, but a little under $200 a foot for the metro as a whole, which tells us what? Your average 2,000 square foot home is going to be just about 400 grand, right? Just about 400 grand. Interestingly, okay, so Minneapolis actually up 0.4%, the metro down 1%. St. Paul price per square foot, like it or not, up the most, 3.5%. Interesting. So couple different interesting things going on, right? I know most of you have seen this, so I'll be pretty quick again in the interest of time. Change in sales, Minneapolis in blue, suburbs in orange. You guys remember the summer of 2020 and all the challenges the city faced then. We did see sales come down, even though sales were rising in the suburbs. What happened shortly after? Sales surged in the city by 30%, while sales in the suburbs were only up 8, 9, 10%, right? So you pull the rubber band back and it sort of snaps back, right? You pull the pendulum and it sort of overswings. And I guess that's what we saw. And now both the city and the suburbs down down about 20%. So pretty even there. I think this surprises people as well. What percent of our homes, what percent of our sales are taking place in our two beautiful core cities? Well, it's about 17%, and that's just about as high as it's been since the middle of 2015. So what is that, an 8-year high? Not quite, because we're just a hair. We're like 0.25% below these levels. So this was kind of the high, but we've tapered off a bit, but we're still pretty much there. So again, I think that would surprise people to say that the percentage of home sales taking place in Minneapolis and St. Paul out of the whole metro is actually as strong as it's been in 8 years. I think people would be surprised at that. Where are sales growing the fastest, or where do we see the strongest sales growth? All right. I mean, we've got a lot of small townships or unincorporated areas. So Linwood Township, 12 to 20 or 11 to 12. I've called out some of the bigger volume areas. Hanover, up 31%, while everything else was down. Corcoran, good volume. Rogers, good volume. Waconia, where I've had pretty good luck ice fishing. Dayton, Spring Lake Park, Somerset. Our friends in Afton are pretty flat. But some of these are pretty big areas, you guys, with, hundreds of sales. And what do you notice about those? They're a little bit further out, right? They're a little bit further out. Median distance between the home purchased and the home we just sold used to be 15 miles, 10 miles, 20 miles, some 2 miles, some 200 miles, but kind of right around that 15 mark. And then now, last year, 50. We went from 15 to 50, 15 to 50, 50 miles. Half the people moved more. The other half the people moved fewer than 50 miles. That's a huge change. Cash sales. Now we got to rush, you guys. Cash sales used to be 4 to 5% before kind of heading into the bubble. After the crash, had some 15, 18, 23% cash years. And then look at how interesting this one is. Only 10% cash. Why? Well, there was all that demand that year, at least in the back half of the year, and a lot of those folks were first-time buyers. How many 33-year-olds do you know with 400 grand burning a hole in their pocket? I know there are some, but not a lot. So we saw cash deals actually decline. And then rates rose on us. And now what do we see happening with cash sales? Pretty interesting, but it makes perfect sense. That checks out, right? Totally checks out. 15%, the strongest share, the highest share, I should say, of cash deals going back to 2014. So what is that? A 8-year high? 1, 2, 3, 4, 5, 6, 7, 8-year high. How deep is the mud? Well, it depends on who you ask, right? Look at this one. Our friends to the north, yikes, they got it worse than we do, folks. So look at us going all the way back to 1980. You've got prices in black, incomes in blue, and then population kind of dashed line at the bottom there. This was tough. Home prices sort of above incomes, or at least indexed, right? Incomes. This is tough now because we're kind of in a similar place. But look at our friends in Canada. I mean, their home prices have just taken off and incomes are just not, they're just not there. They're just not keeping pace. They got a lot of foreign direct investment. I know Vancouver was a big city where they saw a lot of that. They were trying to get a hold on that. I frankly don't keep up with the Canadian housing market like I do ours, but I'd be interested in learning more. But this looks pretty crazy to me. Year-over-year change in closing price for similar homes in comparable locations. National, down 1%. What do we show? Down 1.3. But that's interesting because actually the Northeast and Midwest are actually still showing some strength. It's modest strength, but they're still showing some growth. Our friends in California, no surprise with just how hot that market's been over 10 or even 20 years. In Texas, a lot of growth in Austin and elsewhere. And so no surprise that they're giving some of that back. This one's a little detailed. Oh, shoot, guys. I don't know that we'll have time for some InfoSpark stuff. I wish we did. Next time for sure. I do want to show you guys, we did some rankings based on your monthly home payment. Here's a whole lot of cities that are somewhat similar to us. The top ones are really similar to us. The other ones are somewhat similar, but not quite as similar. Don't worry about income or price or the price to income ratio, although that's interesting. Think more about payment, you guys. So here we are, $2,600 a month for the median priced home. That puts us in 15th place out of 25 metros. So 13 out of 26 would be right in the middle. We're pretty much right smack dab in the middle. So maybe we're not so bad. Where are payments very high? San Francisco, $8,900 a month for the median priced home. $8,900. Who's number 2? San Diego at $6,200 a month. Who's number 3? Los Angeles at $6,000 a month. We'll skip that one. Guys, your housing costs are mostly locked in, right? I think we've done this one, so we'll do it quick. Your housing costs are mostly locked in. There's 7% interest on a $350K loan. There's your payment. Your salary is not locked in. I should say your buyer's incomes are not locked in. They will be growing, hopefully. So as your income grows, but your housing costs remain fixed, the percentage of this income that we spend on this mortgage actually starts to go down. So 30, 35% feels a little high. Sure, I think that's fair. Give it a few years, it'll get to 25, 26 soon enough, right? Just give it some time. Percent of all buyers that are first-time buyers down to 26%. We had 33, 34, even 50% when home prices went on sale in 2010, 09 and 2010. Millennials poking the market, saying, come on, collapse. The majority of millennial renters have no down payment savings. That's kind of scary. I have to say that's kind of scary. So 15% said they had more than 10 grand, 18% less than 10 grand, 67, 2 out of 3 say they had zero saved. That's crazy. Millennial renters increasingly giving up on home ownership. 2018, 13% said we'd always rent. Last year, 25% said they'd always rent. Well, maybe that's not so bad. That leaves 75% homeowners. And actually, in this state, I think we are about 72% home ownership rate. So maybe that's not as awful as we think. But this is national data. So grain of salt. Seller tenure. I know we're just at time, guys. I got just 1 or 2 more I want to share. We used to move every 5 to 7 years, right? And then after the crash, we stayed in our homes for 10 years. And then when we all moved and needed bigger homes with more bedrooms for learning and working, we only stayed in them 8 years. And now, as people started to feel locked into their homes and married to their interest rates, now we got back to 10 years. So pretty interesting dynamic there. Okay, couple more, guys. First-time home buyers now need to be 36 years old. They used to be 33, 32, 31, even 30 years old. They've got to wait some extra years to save up for the down payment if they're gonna, and some extra years for career development and some income growth. Rate projections, very briefly, right? They were thinking we'd be more in the low 6s by the second quarter. All of these folks were wrong. Government agencies, private entity, private associations, they were wrong. They are thinking maybe by third or fourth quarter, maybe we do touch more like 6, even 6.25 would be good. So be watching for this, guys. We're going to skip that one. Let's just talk really briefly inflation. Inflation used to be 9%. It is now 4%. That is down over half, but it is still above the Fed's target of, 2% inflation, 2 to 3% inflation. So we've got a little ways to go, but this really has gotten better. It's why the Fed announced, was that yesterday, Wednesday, or Tuesday? I think it was Wednesday, just yesterday. The Fed paused. They paused on rate hikes. But in their explanation, Powell said that maybe we may have to get back to rate hikes, but they did pause. So I would expect mortgage markets to reflect that a little bit in some of their pricing. But the commentary was, what do we call it? Hawkish. So the rate pause was dovish, but some of his commentary was hawkish. Thank you, Mr. Powell. All right, home price performance moving forward, guys. They're saying minus 1.6 this year. We already had a minus 1.3. They're thinking next year, maybe 2. Year after, maybe more like 3, 4, maybe getting up to 5s and 6s in the coming years. Home price forecast for this year, average of all these forecasts is about 0.1%. That's flat, you guys, right? That's flat. Realtor.com, a little optimistic, and then our friends at Zelman and Associates, a little bit bearish. Okay, 2 more, then all done. Does a recession equal a housing crisis? Well, not really, right? In 2 of the last 6 recessions, home prices fell, but actually in 4 of the last 6 recessions, home prices rose. So no, a recession does not equal a housing crisis. And perhaps more importantly, in 08, remember that was a housing caused recession. So of course, home prices kind of had to fall then. What a recession does mean, at least typically, is that mortgage rates decline, typically. So here's the last sort of significant recessions. 2020 was a tiny recession. I think you guys are still with me here. Usually mortgage rates do fall when that happens. So maybe that's a little bit of a consolation prize for some of your buyers. Guys, I want to wrap up and say we cannot control the wind. However, we can adjust our sails. So be thinking about how to really improve your business, up your game, up your professionalism, level, try to level up, learn something new. Inspection, construction, appraisals, investors, market data, learn to be a data geek, join us, and really just be thinking about, how you can slingshot out of this slower period once things get back on track. And with that, I want to say thank you so much, and thanks for sticking around for a couple extra minutes. And I'll do a quick check of chat, although I did not see anything yet. Oh, just kidding. Megan has a thought. Megan, where do I find the skinny video? Yes, Megan, you're still with us? Yes, you are still with us. Okay, let me show you guys. Let me show you. Right here in videos, there's our skinny right there. You can choose to view all videos, the skinny, our webinar, the skinny, our webinar, some other stuff. You could also go to our YouTube site. You could just click on YouTube and you'll see MPL.
Hi, everybody. My name's Jackson Pino.
Realtors. And then you'll click on that and you'll see all of our videos, absolutely all of them. Good question. Other questions quickly. Okay, you guys feeling good? Thank you for joining us. Thank you, and looking forward to seeing you guys next time.